Banks are one of the most important institutions in the modern financial system. They play a crucial role in providing loans and other financial services to businesses and individuals. However, like any other business, banks are also susceptible to financial downturns that can cause them to go bankrupt. In this article, we will examine some of the key factors that can cause a bank to go bankrupt. Bank run. One of the most common reasons that a bank could go bankrupt is a bank run. A bank run occurs when depositors lose confidence in the bank's ability to repay its deposits. In these situations, depositors may rush to withdraw their funds, forcing the bank to sell off its assets quickly to meet the demand for cash. If the bank is unable to acquire sufficient funds to meet these demands, it can quickly become insolvent. Liquidity crunch. A liquidity crunch is another factor that can cause a bank to go bankrupt. When a bank lacks liquidity or funds to lend, it may become unable to meet the demand for loans. This situation arises when a bank has too many illiquid assets such as long-term loans, and not enough liquid assets such as cash or short-term securities. If the bank is unable to sell those illiquid assets to raise cash, it might default on its obligations, leading to bankruptcy. Systemic risk. Another factor that can contribute to a bank's failure is systemic risk. Systemic risk refers to the risk that the failure of one financial institution could cause a chain reaction and threaten the stability of the entire financial system. In other words, when one bank fails, it can trigger a domino effect, causing other banks to fail because of their interconnectedness. Too big to fail. Some banks are considered too big to fail because of their critical role in the economy. When a big bank experiences financial distress, there is a risk of systemic collapse. Regulators and governments may step in to prevent a collapse, because the repercussions of such collapse could be disastrous on the economy. The idea of too big to fail banks leads to a moral hazard, where the bank may take on excessive risk, knowing that the government will bail them out should they fail. Government bailout. When a bank experiences financial distress from any of the above factors, the government may step in to prevent a systemic shock. This intervention is known as bailing out the bank. Bailing out a bank involves providing it with financial aid or guaranteeing its liabilities, enabling the bank to continue its operations. However, bailing out banks can create a moral hazard, where banks may take excessive risks by assuming their failure would be covered by such a bailout. Cascading effects. The failure of a bank can have cascading effects on the broader economy. When a bank fails, it can lead to a reduction in the availability of credit, which can in turn affect the economy. Credit is essential for investments and business expansion. If businesses cannot obtain loans, it may lead to job losses, reduced productivity, and a decline in economic growth. Bank failures can also lead to social unrest, panic, and fear, which can cause people to withdraw their savings from banks, resulting in a bank run. In conclusion, banks are critical institutions in the economy, and their failure has far-reaching consequences. When a bank faces financial distress, the risk of going bankrupt arises from many factors, including bank runs, liquidity crunch, and systemic risk. Governments and regulators may intervene to bail out banks to prevent systemic collapse, but a bailout creates a moral hazard. Therefore, to prevent bank failures, banks and regulators need to manage risks effectively and ensure adequate buffers in times of crisis. Additionally, governments may need to implement regulation to lessen the risk of systemic collapse, thus diminishing the need for bailouts while promoting greater financial stability.